1. Introduction. Warren Buffett's 1979 shareholder letter is both a financial report and a philosophical reflection. It opens with a discussion about a shift in accounting standards, highlighting how the new rules now require insurance companies to carry equity securities at market value instead of cost. Buffett warns, this creates inconsistent comparisons and accounting oddities within Berkshire's structure, especially between subsidiaries like Blue Chip Stamps and the insurance group. The letter's heart is not just numbers. It's Buffett's evolving worldview on performance, value, and the broader economic climate. He makes a clear distinction between short-term operating earnings and long-term capital growth, championing return on equity as a more honest measure of value creation than earnings per share, which can mislead when viewed without context. Buffett's tone is candid, almost humble, yet unapologetically rigorous. He shares pride in Berkshire's compounded book value growth, while simultaneously expressing concern over inflation's power to erode real investor returns. Even a 20% annual return, he notes, can become meaningless if inflation and taxes consume most of it. This letter isn't just about Berkshire. It's a broader warning about the fragility of financial instruments and the investor's uneasy battle against a monetary system that may not preserve purchasing power. 2. Operating performance versus metrics. Illusions. Buffett criticizes the overemphasis on earnings per share, EPS, as a performance metric, arguing that it can be misleading. A growing EPS doesn't necessarily signal operational excellence. It may simply reflect reinvested returns or a growing capital base. Instead, he advocates for evaluating performance based on return on equity using the cost basis for securities, which removes the distortion caused by fluctuating market valuations. For 1979, Berkshire achieved an 18.6% return on beginning net worth, a strong but slightly diminished result compared to 1978. Buffett notes that although EPS increased, the company's effectiveness in deploying capital decreased. He likens high EPS growth to a stopped clock that still shows consistent gains, cautioning shareholders not to mistake momentum for skill. This emphasis on return on capital is a call for more thoughtful investing. Focus not on superficial metrics, but on the deeper economics of the business. Solid performance must be measured by capital productivity, not just reported profits. 3. Inflation, intrinsic value, and the investor's misery index. Buffett lays bare the existential challenge facing investors. Even with extraordinary business performance, inflation and taxes may wipe out real gains. He notes Berkshire's 15-year compounded growth in book value of 20.5% annually, an impressive figure on paper. However, at a 14% inflation rate, and with capital gains and income taxes layered on top, that return could mean a net zero increase in shareholders' purchasing power. He introduces the concept of an investor's misery index, where inflation plus taxes can erode even the best business results. Through analogies, such as a savings bond that guarantees loss under inflation. Buffett stresses how monetary instability threatens the very purpose of investing, preserving and growing real wealth. He reflects that in 1964, Berkshire's book value could buy half an ounce of gold, and 15 years later, after all the growth and effort, it still could. It quote as a sobering reminder that financial success must be judged in real, not nominal terms. 4. Insurance, the double-edged sword of leverage and discipline. Buffett offers a comprehensive breakdown of Berkshire's insurance operations, illustrating both its potential and perils. He lauds the underwriting discipline of National Indemnity, especially under Phil Lecia, who turned down business that didn't make sense. Rare behavior in a competitive industry. This resulted in strong profits, even as the broader industry slipped into underwriting losses due to softening premiums and inflated expectations for investment income. He warns of a dangerous trend. Insurance managers underwriting unprofitable policies because they expect investment income to cover losses. Buffett sees this as short-sighted and risky. Particularly troubling is the reinsurance sector, where long-tail liabilities can implode years after deals are struck. Yet, amid challenges, he's optimistic. Talented managers and a culture of underwriting integrity give Berkshire an edge. However, he acknowledges the volatility inherent in the business. One bad year in insurance can erase gains from many good ones. It's a business that rewards discipline and punishes complacency. 5. Investing discipline. Avoiding the bond trap. Betting on equities. Buffett uses this letter to issue a blistering critique of long-term bond investments in an inflationary world. He sees them as structurally flawed, financial relics ill-suited for an economy where money continually loses value. He criticizes the insurance industry for selling short-term policies while locking themselves into 30 or 40-year bonds, calling it a cultural and intellectual blind spot. Berkshire avoided this trap by limiting bond exposure and favoring equities and convertible bonds, where optionality and underlying company growth provide better protection against inflation. However, he admits past mistakes, like buying 15-year bonds when warning signs were already clear, and takes responsibility for not acting sooner. Buffett reminds shareholders that fixed dollar contracts, especially long ones, may be fundamentally obsolete in a world dominated by monetary instability. His takeaway is clear. Real value comes from owning pieces of good businesses that can adapt and grow, not from lending money for decades at fixed rates in depreciating currency. 6. Business lessons, turnarounds, delegation, and banking divestiture. Buffett reflects candidly on both mistakes and triumphs. His acquisition of Wambeck Mills, though a statistical bargain, turned out to be a strategic misstep. He admits that turnarounds seldom turn, noting that even brilliant management can't salvage structurally broken industries like textiles. In contrast, See's Candies and associated retail stores continue to thrive due to their strong business models and excellent leadership. He also praises the decentralized structure of Berkshire, where talented operators like Ben Rosner and Gina Begg are given near-complete autonomy. This model, though occasionally resulting in oversight errors, allows for exceptional performance and faster decision-making. Buffett shares the bittersweet news of having to divest Illinois National Bank due to regulatory constraints, despite its stellar performance. While a spin-off remains possible, finding a buyer who treats the bank and its people with integrity is a priority. His message: people and principles matter as much as profits, and long-term value creation depends on both. 7. Conclusion. Buffett's 1979 letter is a masterclass in financial stewardship, humility, and clear-eyed realism. It balances pride in what Berkshire has achieved with a candid acknowledgement of risks and missteps. Operating earnings were strong, yet he tempers enthusiasm with awareness that inflation, taxes, and economic headwinds could erase shareholder gains. His concern isn't just about Berkshire, it's systemic, warning that even the best-run companies are vulnerable in an unstable monetary environment. Throughout, Buffett elevates the shareholder relationship beyond transactional. He treats shareholders as partners, deserving full transparency, not curated PR spin. His reflections on communication, especially his belief that owners should hear directly from managers, underscores a deep commitment to trust and clarity, principles increasingly rare in corporate America. Ultimately, he reaffirms the Berkshire ethos: integrity, rational capital allocation, decentralized leadership, and a long-term view. He aims to build enduring value, not quarter-by-quarter hype. Buffett acknowledges the difficulty of the path ahead, but insists that, with the right people and patient strategy, Berkshire can continue to thrive. Even in a world where dollars shrink and quick fixes abound. His closing sentiment is both reassurance and challenge. He and his team will continue to steward the business with rigor and respect, but long-term success will depend too on forces outside their control. Investors must stay awake,